All right, so this class I'm going to be going over higher time frame structure, okay, and making sure for whatever. So I do treat I teach this inverse model a lot, and it doesn't matter what model in ICT you're trying to learn. It does not matter. I promise you that model will lose every single time if you forget what the higher time frame structure looks like. All right, so I'm going to be emphasizing higher time frame structure in this class. Um, yes, this video will be recorded. All right, so first things first. All right, when I'm looking for a inversion model, maybe on like the 1 minute, okay, I'm just kind of looking at structure here, and this is obviously pretty simple beginner stuff. Maybe for some of you it isn't, but like obviously here we're in a very clear uptrend. Okay, we're creating a bunch of bullish fair value gaps. All right, it's pretty obvious. And this is the 1 minute time frame. Okay, now pretend. I wish I could block this out somehow. Now pretend you didn't know what time frame this was. Okay, but pretend we still had this on like the daily chart. I'm gonna try to. Yeah, I can't block this out or anything. But yeah, like I said, pretend this is like a daily chart. Will this chart still act the same in the 1 minute as it would the daily if the daily appeared the same exact way right here? All right, yes. And then what different, like there are some differences I will say. So what would it be difference between like a daily chart and a 1 minute chart here? Like if let's say they're the same exact thing, okay? Right, let's say they both look like this. What would be like a key difference? Yes, exactly. The time it takes to play out. Okay. No, chop is not a key difference. There is chop in every single time frame. So the key difference from like a 1 minute to a daily is the time it takes to play out. All right, and the speed of delivery, not quite. The speed's still the same. It's just fractal, which it's hard to understand. But for example, let's say I'm looking for a close beneath this to short, which by the way, I did short this on stream on Friday, in the afternoon session. Let's say I was looking for this to close the short, all right? And let's say we're on a 1 minute chart here. Okay, so I'm just watching the 1 minute candles. Okay, you can clearly see none of the bodies have closed beneath this fair value gap, right? If I was in a long position here, this would be, I would see this. I'm like, oh, that's a good sign. It looks like long's gonna work here. Okay, so I wouldn't be interested in short yet. Right, so I just play out price, and keep in mind this is all happening in like less than 15 minutes. And then let's say I see this candle. Now, this is the 1 minute candle, okay? Obviously, because it's a 1 minute candle, we're going to have to wait a full minute till the candle close to take this setup. All right, so now that you understand that, what if this is the daily chart? Okay, I made this mistake on, I think, Friday. What happened was I took a contract here, I took a contract short here. All right, it was on this candle, it was on this wick. Because there was like 5 or 10 seconds left of the candle close, and the candle ended up closing back above. And I took like a starter 1 micro contract here, and what I was gonna do is I was gonna add like 3 more if it closed below, but we never did. So when this candle closed back up, I ended up cutting. Keep in mind that was only a minute. What if I tried doing that on the daily? What if I tried taking a micro here in the daily? It's like, oh, this daily looks like it's gonna close below, and then the daily ends up wicking back up in like the last hour, right? That's the key. That's what I'm trying to show you here, right? When you're taking any setup, okay, you have to understand the time frame you're taking on, because if I'm taking it on like the 1 minute time frame, like right here, okay, what if this was a daily candle, and what if there's like 5 hours left, right? You don't know if we're gonna wick back up or not. You have to wait for the close. So it's the same thing that applies to the 1 minute. If I'm trying to short on the 1 minute, I have to wait for the close. And that's why a lot of people love the 1 minute, is because humans are born not to be patient. Okay, we're all born impatient. If you're born patient, you're probably a very rare human being. But we're all made to be impatient, and a lot of traders are gonna They're not going to trade the daily. Are you kidding me? They're not going to wait for a daily candle close. Okay, it is important to wait for a daily candle close for bias, but like if you're trading the 1 minute and you see something like this where, okay, there's a 1 minute candle close, the 1 minute close just now, then yeah, you can short. But like you have to remember, if this is on the daily and this is the daily candle, there's still like 10 hours left in the day. You can't just assume the bias is bearish yet, because that's what I tried doing on Friday with this candle right here, and I took like a starter contract that I just ended up getting out for like a 5-point loss on. But then I resorted with a mini here anyways. And you have to remember on that daily time frame, that hourly time frame, you have to remember until that candle closes or until that level hits or whatever, nothing is confirmed, okay? So let's say I am looking for like a 1 minute setup, okay? And on the hourly, like on Friday, you can see we're in this 1 hour free rally gap, all right? Now, if I go back and replay to this candle right here, okay, there was a time and point when this candle right here was, I don't even think it'll let me draw it, but there's a time and point where this candle was all the way up here, okay? And when this candle's up here, okay, did it look like the draw was this high? Of course it did, okay? It's always going to, like, again, if you're new to trading or you have experience, you're going to be like, oh, this is a really bullish candle. It looks like this is the high that it's going to be drawn to. Okay, but then what happens the last 20 minutes of the hourly close? Boom, we just get wrecked back down. And then what happens in the next hourly candle? Just a single down candle. And if you're trying to take any model on like the 5 minute, right, you're trying to take like the inversion model, that's the time you want to do it. The time you want to take an inversion model is when we're, or any sort of model. Anyway, okay, it doesn't matter if you trade inversions not here. The time you want to take that model is if we're in like a 1 hour free rally gap, let's say here. Okay, let me change this real quick. The time you want to take that is when we're at like the climax of it looks like we're going the other way. So before, when I had the candle drawn like this, where it looks like this is super bullish going to the high, that's when you want to go to lower time frame and then look for that setup in the lower time frame. Okay, and the reason why is because these people who wait on the hourly time frame, or these retail traders who see a candle like this where the body's way up here, they're going to get antsy and they're going to be like, oh, it looks like this is about to close above. It looks like we're going to go for buy side, right? They don't really know what that means, but they're going to be like, oh, this looks so bullish. Okay, and they kind of guess before the candle even closes, right? This could be the most bullish candle in the world. This could have been a candle till up here, but does it mean anything if it ends up closing back down here? Nope. Okay, so like if you do see any candle like this in the higher time frame where, yeah, maybe it does look bullish, and maybe you are in like a weekly fair value gap, maybe you are in an hourly fair value gap, that's when you want to go to the lower time frame. Then you look for the reverse model, because you know, well, most people are probably bullish there because of how the hourly candle looks. Okay, you know that it's probably not going to be the one to work out. It's probably going to go the other way. And you can clearly see we did have a nice inverse model here. However, it really didn't give any entry, unfortunately. It did in the lower time frame, as I already showed in the 1 minute. It gave us a nice entry there. Okay, same thing on, like, if you don't understand that example, just look at the weekly. Okay, last week, all right, we had a weekly candle 2 weeks ago that it was up here at one point. Okay, it was literally up here at one point. This was 2 weeks ago. All right, and if you are forgetting higher time frame structure, you're just gonna totally miss this. But like in this example, I can't really draw it that great. Actually, yeah, I can. Maybe with a brush. Let me just go with a brush real quick. Let's see here. All right. So you, like 2 weeks ago, this candle was obviously way up here at one point. Okay. Now, if you don't think that looks bullish, then yeah, you can't do this. Damn it. If you don't think this looks bullish, then I don't know what to tell you, because to me that looked bullish when we had it. I'm not gonna do that. I already gave up on that. But like imagine if you could go back in time and you saw the weekly candle like this with a day left. Would that be bullish? Yes or no? Would you think this is bullish if the candle body was up here at this point? Would you think we're going to this high? Yeah, exactly. Most people would. All right, and to tie this all together, what I'm teaching only usually applies when we're in a PD array, okay? And it usually applies to only the higher time frame, okay? And I'm explain why, and this is all gonna connect. Hopefully, at some point for you. But the only reason why what I'm trying to show you is why it only matters inside a PD array, because you're gonna get a PD array to the left of some sort, whether it be here, the example I just showed you. You're gonna get a big wick up. It's gonna look like we're about to close above, and then a day later, because it's the weekly candle, we just don't close above. And if it is from a PD array, right, you know that's very bearish, obviously. That's when you want to go to the lower time frame, and that's when you look for the opposite reversal model, right? So if that was the weekly time frame, we see this. The weekly still wasn't closed above. This was actually on a Thursday, so the weekly candle doesn't close on a Thursday, it closed on the Friday, so it closed right here. But that's when you look for the model. So let's say you're looking for a market structure shift, which this may be your market structure shift. I don't really know. And then you're looking for a fair value gap. That's the best time to look for a model off the higher time frame. Okay, the reason why this doesn't work so much in the lower time frame is I'm going to show you right now. I'm going to show you just a quick example. All right, look at this. Let me see if I can find a good example here. All right, this would be a good example. I'm going to have to edit it. But like right here for this fair value gap, this is the 1 minute time frame. All right. If this candle wicks all the way up here, all right, if this candle wicks all the way up here, in live time, when you see this happen, like when you see this, you're going to be like, oh my God, I'm totally long in this. It's definitely a good inversion setup. But the candle's not closed yet. Okay. Now, because it's the 1 minute chart, that's only a minute of time. So that means if you are looking for a short setup, you'd have to go to like a 5 or 30 or 15-second chart here for that short setup if you did see us wick that high, which is obviously pointless. So it's like, if we close over this, that would be a long setup. But let's say you are very confident in being bearish and you are very confident in equal lows or whatever being down here. Let's say you are confident in that. Then what I'll do is I'll look for an inversion down while we're really high when people think this is about to close as an inversion up. Okay, and that's going to go over some of your heads. But if you saw this wick in live time, that means what? That means people are probably going to be like, oh, the supply zone or whatever zone, fair value gap's breaking. They're going to try to go long. And then what I do is I'll go to, I don't actually do this on the 1 minute, but if it was, I would have to go to the 15-second and look for an inversion model down. And that's what I mean by looking the higher time frame, because I'm not going to 15 or 5-second. That's just outrageous. I don't really like to trade like that. I like to 1 minute best and sometimes a 30-second. But like, imagine if this is a 4 hour. Imagine if the 4 hour candle was all the way up here, right? You could go to the 15-minute, and when we're this high and you know the 4 hour candle hasn't closed yet, if we get that inversion model down again, if this was the 4 hour chart, that's quite a big move you're going to get. Okay. Does everyone understand what I'm saying with that? Like if this is the 4 hour chart and you saw we were this high and you were confident the bias is bearish, this is when we'll get that inversion set up back down on lower time frame. Right? It's going to be a lot easier to do that on the higher time frame than doing it on the 1 minute, because the 1 minute is going to happen so quick. Versus if this is the 4 hour candle, you still have like an hour left to find a short setup. Does everyone get what I'm saying? So again, I go over another thing. Like if we go back to the 4 hour here again, okay. Literally right here. Okay, same thing. We have a fair value gap here. Right? You're gonna have you have a fair value gap here. Okay. This wicks all the way down. This wicks how many points down? This wicks 120 points down, or 130 points down, which is absolutely crazy. Because I'm telling you, if most of you saw this candle in live time, what do you think that's bearish or bullish? If you saw a body way down here, just randomly. Yeah, exactly. You probably think that's bearish, right? And you'd be like, okay, this is probably gonna get violated. But that's when you want to look for the reversal setup. That's when you want to go to, okay, I see the 4 hour candle is a big red candle. It's going inside a fair value gap. That's when you want to go to the 15-minute or go to the 5-minute, whatever it may be. And that's when you want to go to your model, whatever model you feel most comfortable with. Because when we get that really opposite candle, that's going to cause people to chase on like the 4-hour, 1-hour. Okay, you're going to get people to chase. And that's when you look for the inversion model or whatever you want to the upside again, okay? Because obviously you're going to get a lot of, not even just ICT traders, you're just a lot of people in general just chasing that. And I don't think I can, yeah, I have to go to the 15-minute. So right here, this was the play right here, okay? We pumped up. We got this major down move, which obviously to any trader is going to look bearish. And if you lose sight of the 4-hour time frame here and you don't understand this is the 4-hour unfilled fair value gap, okay, why would you look for long here? But because it is, you just have to remember that, and that's why you need to know the higher time frame. That's when everyone is chasing this move down because of how the 4-hour candle looks. What's the number one thing you should know? Even though the 4-hour candle looks like this, what's the number one thing you should know about that 4-hour candle? This is an answer question. Yes, exactly. There's still a lot of time left for that to close. And if you can understand that about the higher time frame, these false candles that have a lot of time left to close, and you know we're in some sort of PD array, you should not be surprised if that ends up wicking back up by the last hour. And that's when you go to the lower time frame, look for that setup to wick back up or whatever. And that's why I preach candle closes so much, because they're so important in the higher time frame. So the candle closes at what, 2 o'clock, I believe? I think it was 2 o'clock. So the candle closes 2 o'clock. So here's the 2 o'clock line for the 4-hour candle. All right. And here's the 4-hour open right here. So here's the 4-hour open. Okay, here's the 4-hour close. And what you're going to see here is you're going to see this down move. Okay. And at this point, you're not really looking for any entries here. You're just kind of watching. And you're going to see us tap into an old 4-hour fair value gap, which is right here. And you're going to see, okay, it's 11:45. There's still 2 hours till the candle close. There's still a lot of time left. I will go to the lower time frame, see if we took any sell side. In this case, we did. I will go to the lower time frame, look to see if we took some sell side while being in this fair value gap. And if we did, I'll just look for a reversal just in case, since we have 2 hours left till this candle close. Okay. And you can see, you just look for your model there. And there's probably some 5-minute or 3-minute or 1-minute model somewhere in here. Okay, I'm not sure exactly where it'd be. I can't go on the 1-minute chart here, obviously, because I don't have enough data or whatever. But there's probably some sort of model in here, or even just taking this reclaimed order block right here. Like this could be a plane itself. Like as soon as this gets closed over, you long, stop back below this. But again, it just shows you that if you lose track of these 4-hour candles or these 1-hour candles or whatever it may be, okay, you really need to be paying attention to when they close, because if there's an hour to the candle close and you got a really bearish looking candle or really bullish looking candle, you cannot trust that till the actual candle close. And that's usually when I find the best reversals. And that's why we find so many reversals at like 10 o'clock, 2 o'clock, we get some reversals, because these reversals are these wicks on these higher time frame candles, right? They're the wicks trying to stop these retail traders out. When this 4-hour candle when this 4-hour candle opens, all that 4-hour candle is going to be a reversal on the 10-minute time frame. Scalpers are going to be like, okay, it's 10 o'clock. I'm looking for a reversal here. Scalpers are going to already be out here, obviously, but that will wick down, and then the 4-hour candle ends up wicking back up. And that's why like 10 o'clock is so important, and why people say 10 o'clock is so important is just that's one of the main reasons. And it all has to do with that candle close, the candle open, and that's why I've been emphasizing that so much. Remember, ICT always says candles tell the story. Okay, the actual candle closes. The wicks do not. All right. Do I wait for displacement up to enter? What would I answer to? What do I wait for displacement up to enter? What do I wait for to enter? Okay, but yes, a break of a fair value gap in IFEG. But is that the right answer to this question? Yes, it can be, but exactly the right answer is whatever model you like to use. It doesn't have to. It can be. I guarantee you, there's some people in here who trade breakers. I guarantee you, there's some people who trade mitigation blocks. It doesn't have to be the IFEG model. It doesn't have to be displacement up. It just has to be whatever model you've back tested. That's your model you're entering here. Okay. All I'm showing you is okay. Here's the narrative. Now on these candles, you just look for your model. Okay. I'm going over really narrative right now. I'm not really going over the inversion model or any model specific. I'm just showing you that if you want to be looking at 1 hour structure and 4 hour structure or whatever, you have to be paying attention to these candle closes. And based off how these candles closes, or if we're really down in a candle, you have to be looking for that setup. So like right here, look at this one right here. This one right here, this was kind of a weird one. See how we wick all the way up here? So at one point, this candle was up here. But would I be looking for a short from there? Would I probably be looking for a short from here in the lower time frame? Right here when the candle's here? Why not? Yeah, I probably want to go for these highs. And there's also one other reason why I wouldn't be looking for short here that I just explained. Yeah, exactly. There's no PD right here. There's no fair value gap. So like in this situation, I would expect this to go to highs. Like that is something that me as being an experienced trader, I would actually expect that. I wouldn't go to the lower time frame here look for a short. Maybe I'd probably go to the lower time frame and look for a long. But if it was example like on the like I just showed you on the weekly or in the daily, weekly, where it's like this, well then yeah, I would look for a short on the lower time frame because I know there's a PD array to the left versus in that other example there was no PD array or nothing to the left really that we should have rejected. So the other example is kind of a weird one. I would have expected to go up, but we did not. We end up looking down. In this situation, it's not like I do expect us to go up here when I see this candle. It's just we're so high at this point. I'm not longing, and I know there's still like a day left till we close or whatever. So I will go to the lower time frame, and I would rather take the inversion model short or whatever your model is short in this example when we're way up here. Okay, but looking for that higher time frame setup always depends on whether we're inside a PD array or not. Okay, because we were inside this weekly PD array. Okay, I know on the 4 hour that okay, or the 1 hour, we could get a short. If we do, it'll probably be high conviction. But for this example where I just showed you guys right here, okay, this 4 hour, if we get a short, I feel like it wouldn't be high conviction because it's like, okay, there's no PD array. Like there's no PD array here. There's nothing. Okay, there's just candles with wicks that are all filled. Okay, this is all balanced. Okay. But you can obviously see there would be no reason in me looking for a short in the lower time frame here. Maybe there's something else like a CE on a different time frame missing, but just from like the looks of it now, it's like, yeah, probably not something I'd be looking for a short. But again, you really want to look for that PD rate to the left, okay? No, Trife. So this is an order block. You're probably talking about this right here. So like, here's an order block right here. Okay, here's the mean threshold. We kind of already used that order block. As soon as we use it, I take it off my chart. I don't really. Yeah, I see we go into it again right here, but at that point, this is like days later, and it's just like I don't see this as effective anymore as I did the first day, if that makes sense. So I don't really worry about the mean threshold this later in structure because it just doesn't. It's already been used so much. It's just like that's just me. I know some people who will have it drawn still, but I typically just take it off my chart just to make them cleaner. It's hit or miss whether that actually works or not. But like once that's used, it's used. I'm all set with using that. It's like a fair value gap. Once a fair value gap's used, both times, right, I get rid of in my chart. So like, here's an example, like it's used to the downside. Am I going to get rid of it yet? Probably not, because what if we use an inversion? But if I see it used right here and then we go down and create more structure, well, at this point I'm like, okay, well, it's probably not going to be used as an inversion anymore. We're too far down. We've already maybe hit sell side. That's when I'll get rid of it, and then it's like I don't use it again. Same thing with, and then if we have like a fair value gap here, it's like, okay, I know we hit buy side to the left or something, or I know we're inside of an hourly fair value gap. I will have this drawn. I'm not going to look for a long setup off it because I know we're inside of an hourly fair value gap. And even when we violate it, I will keep this drawn, because if I'm not looking for a long from in the first place and I'm looking for a short from it, if we violate it, well, then I'm going to keep it drawn even if the long works from it. And then after that short works right here and we hit liquidity or whatever the target is, that's when I'll get rid of it. So after that, because it's like, okay, I took the play for that to be used out to here. And I am making another video on this, probably tomorrow, I'd imagine. But someone asked me the other day, basically what they said is, I don't know what the example was. Let me see if I can find it. I can. But basically, it was something like this. So basically, they thought we had buy side above or something like that. So let's say we had buy side above here, all right? So they really thought we had like buy side up here, or maybe it was equal highs or something. And they saw this, and their play was like this. All right. And they're like, Dachi, why'd this fail? Okay, and I'm like, all right, well, you probably haven't watched my video if you tried taking a play like this. And this didn't fail. This just isn't a setup. Okay, why isn't this an actual setup? Well, the setup was this candle close right here. This is the setup. It has to be on this leg. Okay, that's the setup. And then we end up hitting that internal liquidity anyways. So now that we've hit this internal liquidity, you scale half or whatever it may be here, hold the rest till buy side. All right. But at this point, here's your setup. The retracement back after we hit internal liquidity, by then the setup's just, that's not a setup at all, because I teach these inversions to, okay, we hit internal liquidity. The setup is literally the candle close over the first candle close after the fair value gap. It's not this candle close. It's not this candle close. It's that first one. That's when you look for the setup. And a lot of times what I'll do is I'll let you market buy here and I'll just sell here. Or if we don't hit here first, you'll look for the retracement here. But if we hit that internal liquidity and then retrace, this is not a setup. The setup's already done by this point. Okay, so they asked me why that failed. Even if we still see equal highs above here, this is still not a setup. Okay, because the setup already completed. The setup is off this candle right here. Okay, off this candle only, because that's the first close over the inverse fair value gap. So does that make sense? Again, I'll go to like another example. So it would be like the same thing and right here. Look, the setup here is it's literally right here. This is the setup. Close over, you long, stop loss below this inverse, and you target here. And whether we get a retracement or not, doesn't matter. I'm long. Okay, we hit the target. I'm out there. All right, well, now we retrace back into this. Is this a setup? No, the setup already played out off of this candle, right? This is the setup right here. This is just a whole new, this is something I don't teach. This could be a setup, but it's just not the inversion model I teach. This is the setup right here, these three candles. So you have to remember, this is not the setup right here, okay? This is just, it's not. It's like, this could be a different setup, maybe that's taught, but this candle, the first candle, is the setup. The whatever bounce or whatever later, that's not the setup. So, yeah. Again, so if I go back to like 4-hour structure, Same thing in here. Right, here's a 4-hour fair value gap. All I'm looking for in that, let me go back real quick. All I'm looking for, no matter where we wick in this 4-hour fair value gap, right? No matter if it's here or no matter, like the candle close could be anywhere here. The candle close could be here. It could be here. And keep in mind the candle would have not have closed yet. But no matter where the candle is, I'm looking for those bullish moves being created inside these bearish PD arrays on the higher time frame. Okay, I'm going to write that down. I'm looking for these bullish moves to be with speed, usually, to be created in higher time frame bearish PD arrays. Okay, it's like, again, I say this a lot, but it's just kind of contradicting itself. But those bullish moves inside those higher time frame bearish PD arrays, where you know there's a lot of time till that, where you know where, so knowing there's a lot of time left for higher time frame candle close. That's the other key part of this. So these bullish moves with speed to be created in higher time frame bearish PD arrays, such as this one, when you know there's like an hour or 2 hours left of that candle close, because you know if we get that inversion set up, well, the wick is up here or right here, maybe it doesn't really matter where. You know if that plays out, we have to go down before that candle closes. So it's like it gives you like a time where, okay, this play should work by this candle close or whatever. So like if I just go to the 5-minute here, right, and I see, okay, right now it's 5:55 a.m. The candle closes 6 o'clock. There's the 4-hour candle close. So this wasn't really, this was not a bad example. Go to there. So if you look right here, let me go back to this. Yeah, this is not really, there's no clean setup here. I'm trying to show like clean setup here. But again, on this wick right here, it's 4:45 a.m. Okay, you clearly see it's 4:45 a.m. You know that candle closes until 6 o'clock, and you know we're in that 4-hour fair rally gap. So from that 4:45 a.m. time to 6 a.m., you would be looking for a short, and you know that if that short played out, it'd probably not go back to this high if the candle closes at 6 a.m. So here's 40:45. We know we still have an hour left to the 4-hour close. Now all I'm looking for is the inversion setup, which, yeah, I guess this would be one, I suppose. So this close beneath this 5-minute fair value gap. You're now entering short here, and you just target lower because, again, you know that, yeah, we could close above this by the end of the 4-hour close, but you also know there's an hour left, and you see a short setup right now and there, and that's your confirmation setup out of this 4-hour fair value gap. Okay, so like this is a setup you would take because you know there's still an hour left. Now, if the candle closed, if we were right here and the candle closed at like in like 5 minutes, let's say, then I'd probably wouldn't be interested in the short. I'd probably wait for that candle to close and then see what happened. I feel like these setups, these higher time frame PD arrays, work best if the candle's in like the last 50% of the time where it has to close. So not when the 4-hour candle's in the first 2-hour increment, but when it's in those last 2 hours or even last hour, I would say that's the squeeze time. That's when we can get really a lot of volume. Like, if you've ever watched the charts, you've probably seen at times when there's an hourly about to close in 5 minutes, and all of a sudden a ton of volume will come in, and it will like push us back down inside a PD array right before that close, and kind of like, and it's annoying. You guys in my stream have probably seen it before, but that's because the market doesn't want to go down there yet and it wants to wait like another hour or whatever, because maybe there's some other time-based theory that's interfering with it. But yeah, so hopefully you guys get what I'm saying. Again, just make sure, like, when you are looking for these setups, make sure that the best setups to look for with according to the higher time frame, or whenever we're in like a fair value gap. So like this week, I'll let you show you an example for this week. If I wake up tomorrow and I see that there's maybe like a 4-hour in here, or maybe London maybe does expand to here, right? If I see we're in here, I'll look for that 4-hour candle and I'll be like, okay, when there's 2 hours left or 1 hour left, I'm going to look for a bullish fair value gap leading up to that 4-hour fair value gap. And all I'll look for is that bullish fair value gap to be violated. And that's when I'll take the short, knowing, okay, this 4-hour candle closes in less than an hour. If the bias truly is bearish to the sell side, which I'm 99% sure it is, then before that 4-hour candle close, we should get this setup should just accelerate us down, because the market's going to want to make that 4-hour bearish candle close look bearish. It's not going to, if the bias truly is bearish, do you really think they're going to have a green candle and close it above, right? That means we're probably just not going to go these equal lows. But if your bias is right, what they'll do is they'll wick above, and then you'll get that set up before the candle closes. And literally like 30 minutes before that candle closes, we'll go all the way down, so that when that 4-hour candle does close, it does look bearish. And obviously it should look bearish. It should be like a hammer down or whatever it may be. So hopefully this makes sense. That was the primary focus of the class today. This is a little more advanced of a class. I did notice some people leaving, probably just because they get confused, or they're probably beginners, I'm guessing. But yeah, it's definitely more of a complicated topic, and really requires your brain to keep track of the time and the timing of the candles. Something that I've been doing for a long time. Something I don't even say stuff about it on my live stream. Sometimes I just kind of in my head, like instinctively, but you have to be making sure you know when the candles are going to close. That's why I always pay attention to the 10 o'clock times and stuff like that. So where the scale-outs be, the scale-outs would just be at lower time frame liquidity. So like if we did get a setup like this, I just scale lower time frame liquidity, which if we did get a setup like that, I'd want to see a low put in here. And then if I did get that short, obviously the first target would be the low created coming up to this. So first target would be right here, this internal low that was created before coming up to this or whatever. Yeah, I can do an SMT divergence class next week. Yeah, that's fine. That sounds like a good class. Yeah, make sure to remind me. No, I'll probably remember. But yeah, I can do an SMT divergence next class. I'll go over like Euro and DXY, and then I'll go over like the SMTs with ES and NQ, and sometimes YM I will look at. All right, well that's basically it for that concept. There's not much else to explain. What if you either get it or you don't? Okay, you might have to watch this back a few times. This will be uploaded to YouTube, but is there any questions? Again, I noticed like 20 people left throughout the stream. They probably got really confused. Or I'm guessing they're beginners. That's probably my best guess. Probably like, what the hell is he talking about? Let me know if a couple people typing. Yeah, yes, you can use you can use an inverse fair value gap for a swing. Like in the future, like if we do hit these equal lows and come back up, I would probably use this as a swing, no matter how long it took out to play back up to like here, to these equal highs up here that we left. So like if we hit these equal lows and then inverse this, like I would swing maybe TQQ shares here up to this high. And if you guys know what TQQQ is, it's basically it's a common you can buy, and it's low risk. You can hold as long as you want, basically. And it's obviously leverage, but again, you could just swing those. If we inverse this, I would swing up here. Hey, good to hear setups. Glad to hear Gator. SMT fail is there's an SMT but turns into both taking liquidity. All right, so that is, I've done something in that before where, yeah, I've done something like that before. The SMT failure is interesting. So that's actually, there's a good example of that on Friday. So Friday, we had those equal lows obviously at the bottom, and I would say 90% of the time when we have equal lows like this or whatever, right, if I just do a side-by-side chart here, let me just show you guys what I'm talking about real quick. So we had those 4-hour equal lows on NQ on Friday. And I was saying in my index commentary, I obviously wanted these all day. I said buy SQQ for this, pretty high, which went pretty far. Okay, and when we hit these equal lows right there, or when we hit the low in ES, look at ES. So why can't this? Let me just make sure this lines up. So look at this crosshair I have. So if we draw a crosshair here, okay, see how it lines up with ES here. All right, so it lines up with ES here. This was low a day at the time. This was ES low day. This was ES low day. This was NQ low day. Now, when ES hit low a day here, okay, look, see where the crosshair is on NQ right now? It's at 15.15. So at that time, I was like, okay, just so you guys know, ES did hit low a day already. If there's a bullish SMT to the upside, you're probably screwed. So scale more than usual. And 90, not even 99, I would probably say 90% of the time, like 90% of the time this happens and we've equal lows below, I will probably not expect this to be an SMT, although it can be, okay? And it was last Thursday or whatever YM, we had equal highs, but typically those SMTs will not be SMT if there's a really higher time frame objective that's been waiting to hit for a while. And just because of those equal lows down here, I would not expect the bullish SMT here. Like, I would expect NQ to hit this low day, even though ES already did, just because the higher time frame equal lows, those equal lows on the higher time frame. There will be rare times where that doesn't happen, and we will get a bullish SMT, and we'll go up and do some bullshit like that or something. But typically, if there's really obvious draw on liquidity on the higher time frame, and there's a quote unquote potential SMT that could play out here, most times if there's that higher time frame draw we've not hit on one of the indexes, that SMT usually does fail. That is definitely a harder concept to understand, and even something I don't get sometimes, I'm not gonna lie. And honestly, I don't even know if ICT gets that sometimes, but I've seen videos in the past of ICT's executions, and he'll hold for a move and he'll be like, okay, I want here an NQ. And he'll kind of react in live time. One time I saw him, like, ES hit the low one day, and I think he was in NQ shorts, kind of like this right here. And ES did hit that low, and I remember I replied to it. I was like, why didn't you get out when ES hit the low or scale any? And what happened was he was basically, let's say, this is not exactly what happened, but like he was short from this red line, let's say. And he was short from this red line on NQ. And what happened was he was holding, and he was up pretty good amount. ES at the low, he didn't sell because there was some other sell side down here. And then we got a massive green candle before NQ hit that low, and ES did hit the low, back up. And he ended up just selling. He like trailed the stop, and he got stopped trailing stop instead of just because we never hit down here. And I'm pretty sure he reacted that to live time. He never planned to scale when ES hit the low. He planned ES to hit the low and go through it. But I think he sells when he sees that reaction when we do hit that low in live time, because if he sees ES hit the low and NQ not hit that low and us just rock it up with a free rally gap, that's obviously not a good sign for your position. And that did happen one day, and I remember I replied, I'm like, why didn't you just sell or even scale half when NQ hit the or ES hit the low? And he never answered, but I'm assuming he thought that NQ would hit the low and wasn't expecting the SMT, but the SMT kind of happened anyways. And as soon as he saw that big green candle back up when ES did hit the low, he just got out there. He was still like really majorly in profit, like 30 points. But I think that's something that he hasn't even mastered yet. I don't think you can. I think it just depends on the candles and the price action you see at that very moment, and that's how you can probably tell, in my opinion, because that's usually what I look for: the live reaction to a lower high. If it's session highs or normal high, equal highs, equal lows, that's yeah, that's what yeah, exactly, Brazil. So, all right, well, that's about it for now. This will be uploaded to YouTube. Let me know if you guys have any questions. I'll do an SMT video next week, or SMT class next week. So, again, appreciate you guys coming, and yeah, peace.